Right now, we're seeing everything that you normally see ahead of a major financial crisis, as in 2008. Take a look at the 1930s, the Depression, and you will see something similar, except this one will probably be worse. We're going to see riots in the street, hundreds of thousands of people. We're going to see wars, etc. We're going to see famines. This is an all-time record plunge that you're going to see. Usually, a big bear market, you have at least one index going down 80%. This time, it might be 90%.
Where's the trade right now as we sit here today that you think looks the most attractive? Is it gold and commodities? Bert Dohmen, it is great to have you on Commodity Culture. I want to talk about a private credit crisis that you see brewing at the moment, because you've mentioned that private credit could be the trigger for the next global financial crisis. Walk us through what you're seeing right now when it comes to the danger in private credit markets and how it could lead to a major crisis.
Yeah, I mean, all the warning signs are there. They've been there for about the last year. Private credit is uh, basically disappearing. The big companies that are investing in private credit, they're trying to whip up sentiment that they're looking for foolish and uh, inexperienced investors to take the garbage off their hands. And, you see it in the private credit funds that people are trying to get their money out. They can't get their money out of these funds, although it's their own money. But the companies won't give to them. That includes even big companies like, BlackRock. I mean, it's incredible. When you see this, and if a person gets almost zero publicity on financial TV, because financial TV is owned and paid for by Wall Street, by the people in charge. So right now, we're seeing everything that you normally see ahead of a major financial crisis, as in 2008. 2008, we called it early in the year. Goldman Sachs at the time was very bullish on the market. And in fact, I remember oil was, they were forecasting a new oil high uh, around 190 or something like that. I said, no, we just got a major sell signal. We're going into bear markets everywhere. And that's what happened. Of course, it was a major financial crisis that we went into, and people were not forewarned, except our subscribers. They were forewarned, so we made a lot of money in that debacle by selling short. September 4th was the big date. When Lehman Brothers went bankrupt, so that's it. And we had uh, a few ETFs that we had recommended, and they were up something like 94% in 3 months. And see, you can make a lot of money when you're on the opposite side of the masses. When you are on the same side as the masses, you know you're going to be wrong. Get out, reanalyze, find out why you should not be there. You you have to find comfort in being a contrary and being alone. You know, and I love it when I'm the only one.
Well, before we hit record today, you said the current situation reminds you of the 1970s. Could you walk us through those parallels you're seeing, and do you expect things to work out the same way in our current market environment as things did back then?
It was the same type of disbelief that we have now. The gold, I think, in 1978, when we got on board, was about $128 an ounce. It would get up to $800 in the year 1980, which is a few years later, $800. And we were along for the whole ride. I mean, we had the call options on the mining stocks, et cetera, et cetera. There were no ETFs at the time, but yeah, it was an exciting time, and it was really kicked off by the Federal Reserve, and I kind of expect that to happen soon, and soon be like tomorrow, when the Fed has its first meeting with the new Fed president. But in 1978, we got a new Fed chair, and he said, we're not going to fight rising inflation with tight money. We're going to do it with the interest rate policy, raising interest rates. And I wrote at that time in our Wellington letter, which was only about 2 years old at that time, it said, that is a green light for very high inflation ahead. You got to buy all the commodities. The commodities are going to be greatest beneficiaries. And that's what happened. And it was because the Fed did not tighten money. They kept on raising interest rates. When you raise interest rates without tightening money, you actually fuel inflation because the higher interest rates are a cost of doing business. So businesses then raise money, and they can they can raise prices, and they can get away with raising prices because money is loose. See, it's so simple. So simple. When you have loose money, you can go to the bank and say, like a loan for $100,000. Oh, we'd love to give it to you. It'll be ready for you in a minute. Yeah, that's loose money. Okay, we had that 1978 to 1980. Then Paul Volcker came in because the double-digit inflation. We had inflation going sky high. I remember the chief economist of Goldman Sachs was doing a seminar in our town, and I was invited. And so Gary Wenkelowski was his name. And so they were forecasting a high in the prime rate of 12.75%. And I said, what do you think about the possibility of the prime rate hitting 20%? He said, well, that's absurd. Our financial system would not be able to stand that. I said it would if inflation is high enough. And it's exactly what happened. The prime rate in 1980, just 2 years later, was 20%. Yeah. And then Paul Volcker came. Paul Volcker said, we're going to have tight money, tight credit. So you go to your bank, even the best credit risk, the bank is reluctant to give you a loan, but we don't have the money. And that is tight credit. Okay. So that's what you want to look for. And Paul Volcker shut off inflation for about 40 years. And we had a terrific investment. We've been selling short treasury bonds all the way up in that as interest rates went higher. It was a great trade in 1980. Said, okay, big turn, another opportunity of a lifetime. The long-term T-bond yields had made 100-year high. And I said, 100-year highs don't last. You buy treasury bonds. So we own all the treasury bonds, and especially the zeros. The zeros have the coupon clipped off. So in effect, they act like a leveraged instrument. So, in 10 years' time, these went up about tenfold. And if I kept it longer, which I didn't, in 40 years' time, they were up 40-fold. Can you believe it? Yeah. And we had one client, he financed a huge luxury home subdivision with the profits. Yeah. He called me up one time and said, well, okay, I got my account ready. He said Solomon Brothers. He didn't even know who Solomon Brothers. And I said, okay, maybe you're going to go. I said, how much leverage? I said, maybe 2-to-1, and it'd be conservative, And a week later, he called me and said, well, put the $10 million in, but about $100 million worth of T-bonds. So 10-to-1. That's how people are. Luckily, because I told him you're going to be financing the purchase, the money that you borrow for the bonds with overnight repos. And so you have to explain what the repos were. Said overnight repos. So you eventually you're going to have a huge carry. Right now, you're paying 15% for the short-term rate that you borrow, and you're getting 15% on the T-bonds. But eventually, you're going to be getting your 15.25 was 15.25 on the T-bonds, but you'll only pay about 7% for the overnight money for financing. and it worked out perfectly. See, these are the kind of things, and the smart guys on Wall Street, of course, do this for themselves and for their firm, but they don't tell you about it on TV.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell them, of course, that Commodity Culture sent you. And now, back to the interview. Well, where's the trade right now as we sit here today that you think looks the most attractive? Is it gold and commodities, given that you see a similar setup to 1978 at this point in time?
I think commodities, I like the commodities indices. They have DBC and DBA. DVC is for general commodities, DBA is for agricultural. We're going to have a huge shortage of agricultural goods. The farmers cannot afford fertilizer at today's prices, or they can't even get it because it's not coming out of the Strait of Hormuz. So that's a big problem. So we're going to have a shortage of farm products in a few months. Yeah. So when the shelves start getting bare in the supermarkets, then you'll know, we do have an energy crisis. The Strait of Hormuz must still be closed. Yes, it is closed. Right now, you know how many ships are coming through the Strait of Hormuz? That's 24 hours. Zero. And on TV, they pretend like nothing has happened. Oh, well, that's going to be a result. Look at oil prices were even down today, because of some chatter. Yeah, Iran really wants to have an urgent peace meeting, Iran, they're not that stupid. I mean, they're right in the middle of negotiations that bomb the negotiators. Who does that? Never in world history, even the worst country has done that in the middle of peace negotiations. They have a white flag, and that means no shooting, no killing, and so on. No, we use that as an opportunity to kill their leaders. What has that happened to the decency of the United States? It's really a shame. I completely agree with you. How do you think the war is going to affect the global economy and financial markets moving forward? Because you're right, people are quite complacent at this point. So far, so good in terms of the Western world being able to go to the grocery store, get the things that they need. Oil is dropping, as you mentioned, for some reason, which seems crazy considering everything that's been going on. How do you see this having an impact should it continue on for perhaps longer than most are anticipating? Well, I'm not the only one seeing this, but the eventual outcome is depression, a global depression. And that will actually activate my forecast for the decade that, in my business, we always do that at the start of a new decade. We give a forecast for the decade. And my forecast was said, just take a look at the 1930s, the Depression, and you will see something similar, except this one will probably be worse than what we had in the 1930s. And it's happening. So we're going to see riots in the street, hundreds of thousands of people. So we're seeing millions of people in the street now. We're going to see wars, etc. We're going to see famines, etc. They're having in Africa, they have huge famines because of the local wars and so on. So this is a terrible situation, and we got into a war. There was no need for it. We were not threatened by Iran. I talked to some people I know, but I said, why did we attack Iran? Oh, well, they've been threatening us for 47 years. I said, how? Well, they've been saying, bad things about the United States. I said, you call that a threat? This is ridiculous. And for that, now we're killing thousands and thousands of people in Gaza, starving to death. hundreds of thousands of people, women and children, not soldiers.
It's completely insane.
It's very sad.
Yeah, it is very sad, and of course we hope it gets wrapped up. I am wondering what your thoughts are on gold here as an asset class, because interestingly, after hitting all-time highs earlier in the year, we've seen quite a correction in the gold price, particularly since the war kicked off. A lot of people expected gold to rise as global conflicts, expanded. It has fallen instead, and everyone's wondering what's going on with gold. Is the bull market over? Wondering what your thoughts are.
Yeah, it's wherever the masses are is where you don't want to be. And so just about everybody was gold and silver near the top a few months ago. And so we have to see that wash out. Yeah. And once everybody's out, that's when the big money goes. Okay. The big money doesn't go in when prices are still higher than they would like them to be. They want to get bargains. Okay. They're very natural, right? They're not dumb, So they see that there's still people who are bullish on gold, and especially with the war, everybody thinks the war is bullish for gold. No, war is not bullish for gold. You know, you have to identify what is bullish for gold. Inflation is bullish for gold. That's it. Yeah, and so uh, I think this time around it's going to take more time until the last bulls are gone. Then you're going to see a big catch up move in gold and silver. Because let's face it, the central banks, not only the Fed, but the central banks have no alternative but to create a huge, even record amount of money. I mean, much bigger than what we have now. And that fuels speculation, okay? Artificially created money. Speculation fuels borrowing to speculate. That's what we're seeing now. Margin loans on stock purchases are a huge $1.5 trillion. That's borrowed money that you can get a notice. We need you to pay back your money in the next 3 hours. Otherwise, we're going to sell you out. So you don't even have a day to get the money. This is reality. People are buying the crap, garbage, like all these cryptos that have zero intrinsic value. They're all going to end up at the same price, which is zero. Okay. So right now, we're in a situation where people really have to get out of debt. They should not be heavily indebted. Margin credit is at an all-time record high. All-time record high. Now they're even coming out to CME. It just came out with a new instrument. It's a single stock futures contract. So they're making a commodity contract out of one stock. That's the only asset that futures contract has is one stock. And this is ridiculous. And then you've got the prediction market, of course, where you can bet on which way the weather's going to go, or a football game or whatever. So, I mean, Wall Street is now trying to compete with the casinos in Las Vegas. Is that what we really want our stock market to be?
Yeah, that's a great analysis. Now, speaking of the general stock market and this whole casino mentality, we're seeing sky high valuations across the big tech names. We saw the SpaceX IPO, which somehow both retail and institutions seem to pile into. In the beginning, we've seen it, of course, fall from its initial IPO price now. But this is a company that was regularly reporting massive losses, and yet people piled in because Elon Musk and he's going to bring us to Mars. I mean, this is reaching peak level of insanity here, and everybody's been talking about how it's a bubble and it needs to burst soon. I'm wondering what your thoughts are on when we could finally see this thing burst, because I believe you're in that camp as well, and how big of a drop the broad market could take in such an event.
Well, it's obvious. I mean, these are all the signs that you see at a major top, not pardon, not a short-term bear market. Yeah, you don't see this. This this is an all-time uh, record plunge that you're going to see. The liquidation of debt is going to be enormous. You know, and so that's where how deep is it going to go? Usually, a big bear market, have at least one index going down 80%, and usually it's the Nasdaq. Yeah, this time it might be 90%. So that's the kind of thing to look forward to. And but who is prepared for that? All these speculators. I mean, I meet these speculators when I go to our club and so on. The young guys, and 19 years old with their laptop and they're day trading. I said, "Do you know who's on the other side of your trades? You know, it's the algos. You know, and they have super fast computers, and those computers can enter 90,000 trades per second. Trades, not shares. 90,000 trades per second. You think you can compete with your laptop? Yeah, it's ridiculous. People are so unrealistic when it comes to, they never really even think about risk. For me, any new investment, my first thought is always risk. Where is the risk? How much is the risk? Not how much money I can make. But most people have that turnaround and say, oh no, I can triple, I can quadruple my money at this. No, that's not the right question. The first question, what is the risk?
Is this a time when you would be keeping more cash on the sidelines than in a normal market environment in anticipation of such a massive drop?
Yeah, we are now in the bear market. Most people don't know that because financial TV doesn't tell us. Yeah, but we've got look at 7 stocks in the S&P 500. 7 stocks, the mags, magnificent seven. They call it. Okay, 40%, 40% of the capitalization of the index is these 7 stocks. Now, is that a stock market? It used to be thought a stock market is a market of many stocks. No, 7 stocks have 40% of the capitalization. Yeah. So, yeah, it's really sad. The look at I have a short list of some of the bear market signs. SanDisk, which was a high flyer, right? Yeah. Do you think it's still in the bull market? It's up. It's down 53% from the high. Down 53%. So if you bought near the top, you've lost more than half your money. So the Micron is down 36%. Western Digital, which makes hard drives, they're down 45%. Yeah. So you've got Oracle. Oracle, everybody knows Oracle, right? It's down 54%. Yeah. IBM down 39%. I mean, these are not small stocks. Yeah. And they're deep, deep, deep into bear market territory. And nobody calls it a bear market. This is a bear market.
Now, do you think the Trump administration is going to fight tooth and nail to somehow keep the valuation of the broad market afloat? Because it really does seem like they look at the big indices as kind of a barometer of the economic health of the country, which makes no sense, but that's how they look at it. They've already taken a stake in Intel and a few other companies. Do you think we could see the government more directly intervene in markets in terms of taking stakes in some of these big names to hold up the S&P, for example?
Yeah, that's a good question because this government is liable to do anything. So you never know. You never know. It's very unusual that they took these stakes in private companies, but I thought it was first going to be just one company. No, one after another after another. Of course, the insiders that know what's going to happen, they load up in those stocks and they make a fortune in just a few weeks' time. So I don't know if that is the goal or the goal is to support the market. Who knows? Yeah, but uh, but the government doesn't have the money. Where is this money going to come from? Yeah, and that's the problem. Everybody look at the money that AI companies are needing and borrowing. Everybody considers it, oh, this is bullish. This company, they're going to borrow $50 billion. How is that bullish? Go on debt by another $50 billion on top of what you're already. So and debt in the kind of environment we're going into, that is not going to be very good unless we go into hyperinflation. That's the big if. If we go into hyperinflation, and if you read about the hyperinflation in Germany in the early 1920s, there was a German industrialist, Hugo Stinnes, Stinnes, and I have the book. Read the book and how he made money during the hyperinflation. He kept on borrow money, and bought new companies with the money. So pretty soon, the money he borrowed, let's say it was 10 billion marks, then 10 billion marks couldn't even buy you a loaf of bread. Okay, so he bought all these companies. And at the end, he said he owned 3,000 to 4,000 companies, and he had so many he couldn't even keep track. And he bought one of his own companies, not knowing it was his own already. You know, but but he was smart. He was borrowing and borrowing and borrowing. So if we go into hyperinflation, yes, you want to borrow like crazy.
So you think hyperinflation is potentially on the table? And is this for the US dollar? And if we were to see the US dollar hyperinflate, what would that do to fiat currencies globally? Would we see a cascading effect where we'd see hyperinflation around the world?
Yes, I think so. I think, for example, if we set the example, then the other countries will feel, oh, we can do the same thing. Germany used to be different. Germany wanted to be different and not follow in the footsteps of the other EU nations. But the government in Germany now is as bad as it is in England and all the other countries. So you cannot better anything anymore. Yeah. The things we know where to look. Okay. And that's what we write about. The Wellington letter, we've got about 25 pages twice a month, or so it's 50 pages, single space, newsletter and best research that you cannot find anymore. Yeah, it's the best part that's out there. And what you get is you get my experience. Okay, I've been trading the markets for over 60 years, and you learn something in that time. Yeah, you learn from your mistakes, but I made the mistakes with my money, not managing other people's money. Okay. So, look, most money managers, they gamble with their clients' money. Okay. I don't. So, but you learn a lot. You learn a lot when you own money, etc.
So in this hyperinflationary scenario, is holding physical gold and maybe even silver in your possession one of the best ways? Because obviously that's the mainstream thought when it comes to the gold and silver space, is that if a hyperinflation or just inflation in general, gold is a hedge against inflation. Is that what you want to be holding in that scenario?
I would. I always think of if I were the richest man in the world, how would I want to protect the purchasing power of my money or of my wealth? And you do that by having something that maintains its value. Gold has maintained its value for its thousands of years. It always has been the safe haven for money. So I don't see that trend changing. But so you want to make sure that you have something that protects the purchasing power of your money.
In the event that we get this 80 to 90% crash in the broad market, where would we go from there? Because I've heard a few different, there's several people I've spoken to have similar outlook to yourself. Some people say in the aftermath, we could be looking at a decades plus recovery time before reaching previous all-time highs, as what happened with the Nikkei after it crashed in 1990. It took over 20 years for it to get back to previous highs. Do you think we could be in for that sort of scenario? Do you think the market could recover more quickly? And how would you approach, looking for bargains in that type of scenario, considering how long this bear market could potentially go on for?
Well, you can never predict the actions of the politicians. They don't know themselves. The current head of the country, it doesn't know what it's going to do in the afternoon when it's a morning coffee. So there's no plan for anything. There's no strategy, and so you just cannot make these long-term forecasts. So the best thing that we always say, we don't know when it's going to happen, but we can identify it when it happens. That's the most important thing, And so we've done it in every bear market. We've got the tops and some of them early, but people always think like Warren Buffett, for example. He's been in big cash. I think it's $360 billion in cash he's holding right now because he says he cannot find any stocks worth investing in. Yeah, that's important to know. I remember I was in graduate school at the university and read an article about this guy in Omaha, Nebraska. He had a small fund for his friends and family and so on, and his outstanding performance, his philosophy, and so on. And it was Warren Buffett, So he's a smart guy. Yes, he got into cash, according to some people, too early. So he missed some opportunities, So some people think that your market timing has to be right to the day. No, it doesn't. You just, in order to avoid the 80 to 90% plunges in the market, you want to be out early. Look at the examples I gave you here. Stocks like or down over 50%. Wouldn't it have been great to get out of that stock maybe 6 months ago? Yeah. So yeah, you could say, oh, but the S&P went up and the QQQ went up, and so that's not the way to look at it. You have to be aware of the risk factor, and when you make a little table like this, a popular stock that are down deep into bear market territory, and nobody talks about that it's a bear market. Boy, you better watch out because somebody's pulling the wool over your eyes. The stock market is not a fair game. Wall Street is not in business to make you money.
Yeah, very well said.
Yeah, in the bear market, the individual investor is the bag holder. Joe Grenville coined that word many years ago. Of course, nobody knows what Joe Grenville was anymore, but he had a newsletter. He was great. I knew him personally. And he always said, the retail investor is the bag holder. Because think of it, somebody has to own the stocks on the way down 80 or 90%. Wall Street doesn't want to own those stocks during that time. So they elect you to hold the stocks all the way down. Okay? So the public becomes the bag. And when it's at the bottom, then they say, oh, you want to sell your stock? Be glad to buy it from you. And they buy it at the bottom. That's the truth of the game. And now with AI, it's even much simpler. They can do all these things with the output trading and so on. It's there's a little guy who's trying to trade the market, is going to be very unsuccessful, and that's why I was started out trading at the markets myself many years ago, but now I say lengthen your time horizon. Don't go for 1 or 2 week or 2 month gains. Lengthen your time horizon. That's the way to make money in the futures, because the algo traders, they're not going to hold a stock for 5 months. So you're going to be immune from their manipulation if you can stand the daily wiggles. But that's it's so important to choose your time horizon and not to say this stock is my long term hold, and then the day after you buy it, you say, "Oh, it's going down. I guess I'll sell." Yeah, no, yeah. I remember one time I spoke at a lot of conferences, and in the men's room, somebody said, "Oh, Bert, you were in a gold panel yesterday. You were bullish on gold." Well, you were wrong because today gold is down.
Yeah.
I mean, okay, I mean, I couldn't believe it that a person would say that. I was wrong. But this is the time horizon of many investors.
Yes, and that's a very, very good point. Why don't we end with discussing Dohmen Capital and your letter, where people can get it, dohmencapital.com. Obviously, you can go there. The link will be in the description below. You've got a great free report on the private credit crisis. It's a very in-depth report. People can download that for free on your website. And tell us about the Wellington letter and any other products you have available there too.
The Wellington letter, as I said before, it's about 24, 25 pages twice a month. A lot of stuff in there. Follow the economy, what's wrong with economists. Because the economists are never right, And when I went to college, I was going to get a business degree. Well, after the first semester, I said, I can't do this for 4 years. The people who wrote these textbooks, they never had a business, So I said, I need something to challenge my brain. So I changed my major to chemistry and physics. And that was wonderful. Boy, I call it brain stretchers. They really stretch your brain, So that was great that I did that. But I still took 2 years of economics, okay? Because I wanted to see why our economies always so wrong. Not sometimes, always, always. Why don't they? What I found out it comes from the textbooks. The textbooks are terrible. They're written by people who don't know a thing. And like Samuelson, he even got the Nobel Prize for his textbook. 10, 15 years later, he had to change many things in his textbook. And he admitted he was wrong and this and this and this. I said, "Oh, these are the things that I debated with my professor. Can I go to my professor now? You get my A minus changed to an A." So, yeah, in advanced economics, they got into calculus, using calculus to predict the economy. And I thought it was kind of useless. But so the professor called on me all the time because he knew I knew calculus, as a math minor. And he didn't know calculus. He was teaching the class. So I had to go up and teach the class when it got to calculus. Yeah, this is our educational system.
Well, I'm going to put a link.
But
go ahead. Yeah.
Our newsletter is, I think it's $750. I think we're running a special right now. I'm not sure, but go to our website. You get that free report on private credit, and it's the lower rung of the credit quality that always leads to the crisis. Like the last one was junk bonds, right? Junk bonds were key, and so you always want to look at the worst parts, and I know I have a friend, and he's the top executive for one of the private equity firms, and he told me last year over dinner at his house, he said, "Yeah, okay, we're making loans at 13% interest." I said, "Companies are paying you 13% interest on getting loans?" He said, "Yeah, it's wonderful. They're really strong companies." And I said, "Someone is paying you 13% is not very strong, because they could get a lower rate someplace else. I would be really worried if lending money to somebody at 13%. Yeah, but the thoughts, yeah. So that's the way. We do have two trading services that come out several times a week. One is for stocks, and the other one is for ETFs. Okay, and so we have some for both type. We have in our stocks or ETFs. They're always suggestions. We don't tell you what to do. Yeah, every person is different. Every person has to make their own decision. These are suggestions. Check it. We always say, check it out yourself. Yeah, verify. I would say, verify before you trust. Reagan said, trust before you verify. Yeah, I say, verify before you trust. We had dinner one time with Mr. and Mrs. Reagan, and that was before he became president, just before he decided to run. Delightful person. He was. I've met a lot of top politicians in my life, but he was the first honest one. No, the first one, maybe. And the other one was Ron Paul. You know, honest politicians are pretty rare.
Oh, yes, they sure are. I had Ron Paul on this show, a great guy, and one of the few good people in the fight when it comes to the political realm. Hopefully someday we'll get to abolish the Fed as he has been trying to do for his whole career. Well, Bert, this has been a fantastic conversation. I'm going to go ahead and put the link to domencapital.com in the description. Download the free report. It's excellent. And check out the Wellington letter and everything else. Bert, thank you so much for coming on. It's been a blast.
You're welcome. It was my pleasure.
Thank you for joining us today. This episode brought to you by ARC, Silver, Gold, Osmium. They have some great prices on gold and silver bullion products. You can see some of them on your screen right now. These are subject to change and well supplies last. So reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him that Commodity Culture sent you. And we're building a community on WhatsApp. Join the Commodity Culture WhatsApp group. You'll get the chance to submit questions for upcoming guests, as well as be part of a community that is there to give each other investment ideas and feedback. So the link is in the description. Join today, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.